Hi, my name is Arkadiusz Trzciołek. I am a fixed income strategist at PKO Bank Polski.
The rally on Polish bonds, which started at mid-November 2018, has likely come to an end. Although the Polish debt market held strong at the beginning of the year, some rebound of the yield curve was already warranted. This time, as a trigger for a significant upward shift in the Polish sovereign curve, served the government's social spending plans. The extended subsidy in child benefit program, effective from mid-year on, and an additional one-off pension are estimated to cost roughly 20 billion zloty this year. While the social spending may not lead to increased borrowing needs this year, the budget deficit in 2019 is likely to be higher than the 10.4 billion zloty last year. Although Poland's sovereign credit ratings remain comfortably in the investment-grade area, and the trend among agencies recently was skewed towards improvement of their assessment, foreign investors continued to scale down their PolGB portfolios. To some extent, we view it as a profit-taking after the aforementioned rally. The non-residents' share in marketable bonds fell well below 30%, far from historical highs above 40%. The point that foreign investors reduced their positions mostly on valuation ground, not as a result of fundamental change in approach to the country, is backed by a solid demand for green bonds, as in the latest issue, Poland tapped 2 billion zloty in 10-year and 30-year papers, with 4.8 billion zloty of demand coming predominantly from foreign bidders. We believe that it is unlikely that yields on longer-dated bonds in Poland will revisit their 2019 lows. Even though the outlook in the European economies seems gloomy, which led the ECB to extend its forward guidance on rates and launch the third round of TLTRO auctions, the mix of local factors is not as supportive for local bonds as during the rally last year. Our economists forecast that the 2019 deficit is set to increase slightly to 1.8% of GDP from 0.7% last year. The 2020, however, is a different story, as the ratio may rise to 2.9%, dangerously close to important 3% mark. Although we do not expect a significant increase in bond supply in the near term, as the Minfin already financed 61% of this year's borrowing needs, the authorities may step up issuance in the fourth quarter in order to secure some financing for 2020. Inflation in Poland has likely reached a trough in January at 0.9% year-over-year and may even rise towards 2% by the year-end, which should limit the scope for decline in yields. Despite the assumptions that inflation stay below the 2.5% target this year, which is also in line with the latest projections from the National Bank of Poland staff, any easing of local monetary conditions is unlikely. In fact, at the March meeting, Governor Glapiński suggested that such move was never seriously discussed during the term of current council. The MPC stance is shared by the money market, which does not price in any rate cuts in Poland. Among the key risks for our forecast are the geopolitical developments with still unknown outcome of the Brexit negotiations, trade talks between the US and China, as well as the packed election calendar, which commences with the EU parliamentary elections in May. Additionally, the stronger rise in bond yields may be limited by the accommodative stance among central banks, where Fed may extend pause in hiking cycle or end the process of reducing its balance sheet. Thank you for your attention. In case of any queries, please do not hesitate to contact me.